Hi, my name is Aaliyah, and today I want to go over how to invest in the stock market because I feel like a lot of people have this question and they want to get started, like they're interested in stocks and they want to get started, but they don't know where to start because the information is so overwhelming. Like, there's so much to know. Like, what do you do? Where do you start? And so, in today's video, I'm going to highlight like the different steps. I'm going to break it down into different steps about how you would go about investing in the stock market. And so I guess this is gonna take some like self-reflection. And so the first thing you want to think about is like, what is your investment goals? Like, what do you want to do in the stock market? And so the first one, investment goals. Investment goals. And so you want to think about, what do you want out of the stock market? Okay, some people say like, oh, like I want to get rich, whatever they want. And so you have to think about like what do you want out of the stock market? What do you want to do in the stock market? And so the four things I want to go over with that regard is the four different like investment styles. And so the first one would be like, and I'll go from the shortest to the longest. So the first one would be day trading, which is where like you buy a stock and then you sell that stock in the same day. But that's very risky and people lose a lot of money doing that. So I wouldn't suggest any beginner or someone just starting out to try that. I would suggest, like, if you want to do that, get a feel for the stock market and how stocks move before doing that. And you have to have quite a bit of capital to start off doing that. And so that's the first one. The second one is swing trading, where like you hold on to a stock for like a couple of months, or you swing trade the stock. So you buy it and sell it within a couple of months. It's pretty short basis. The third one would be short-term trading, which is usually like 3 to 5 years, where you think a company is going to be well for the next 3 to 5 years, but maybe you don't want to invest in it for the long term. And so you have a very short basis on this company. The fourth one, which I think a lot of people watching this video would be long-term traders, long-term investors, where you believe in a company for the long term and you want to invest in this company, you want to grow with this company for the long term. And when I say long term, I mean like 10 to 20 years. And even in this fast-paced environment that we are in now, like companies come and go. A lot of the different markets aren't like mature as of yet. Especially like the technology sector, which I think a lot of younger people would be interested in. I would say even like long term, that could be like 5 to 10 years. But just thinking about, like, you want to be with this company, you want to hold your money in this company for the long term. Like, you love this company, you love the fundamentals of this company, and you think this company is going to last and be around, and you can grow with it and have your money appreciate during that time. And so I think a lot of people watching this video would be interested in long-term investing, which is I that's what I do, and that's what I'm most interested in. And that's what I'm going to tell you about a little bit more about today, because I think a lot of people watching this video again would be most interested in that. And so the second thing in the stock market, before you put your money anywhere, like before you get your wallet out or anything, like the first thing you want to do is learn the basics of the stock market before you put your money into it, so you can understand where you're putting your money. Like, this is your hard-earned money. You want to put it into companies that you believe in, but you have to know how to assess a business, assess a company. Make sure at the end, you should be able to say like, okay, this company I believe in for the long term because of this, whatever facts you have. Because listen, everybody's given the same information, okay? Everybody's given the same financial, income statements, balance sheets of a company. And some people, given the same information, some people are like, this is a good investment, I want to put my money into this. Or this is a bad investment, and I don't think anybody should put their money into this. And so people have bullish cases about why they think a stock is going to go up and why they want to put their money into it. And then some people have bearish cases why they think a stock is going to go down and why they don't want to put their money into it and why they think other people shouldn't put their money into it. And so learn the basics. And so I think this trips a lot of people up because learn the basics, that's such a broad term, right? And so what are the basics? What I would do if I were you is to learn as much as you can. And so what I would do is I would go to like finance.yahoo.com. So Yahoo Finance, search any company that you really like and really know. Like for me, I know Apple well, and I think a lot of people know Apple well. A lot of people have Apple products. They understand the company, they understand the business. And so like a company like Apple, like, you know, they make computers, they make iPhones, they make the watches, they make the earpods and AirPods. Like that's a very easy business to understand. And so looking at their, you know, financial data, you can see how many iPhones they sold, how many, well, not anymore because they don't disclose that, but you can see how much of their revenue comes from iPhone or Mac or like whatever. So like it's very easy to understand, and you can take it in and learn. Like you don't have to worry about like, oh, how do I assess this business? You can just look at the financial data instead of saying like, how do I understand how this business operates and that type of thing. And so go to Yahoo Finance, look up a company like Apple that you know and you love, and just go through like the different tabs, and anything that you don't quite understand, I would do a Google search for. That's basically how I learned everything there is to know, because when I started out in the beginning, I couldn't even tell you the difference between like revenue and income. Like, and that's, you know, that's like, I feel like that's very basic, but I couldn't even tell you that. But I self-taught myself everything that I learned so that I can look at income statements, I can assess balance sheets. I can basically like look at a company and, you know, note this, like, oh, their debt to equity, their PE ratio, like these terms you're going to want to know. And so I will highlight a few of these terms that you really should know starting out. All right, so I'm going to list a couple of things that you want to know, and I'm not going to go through in this video, but that you should know just to get you started, okay? Because with this, you're going to have to do some studying, some research, and so just to get you started. And so I think the first thing is just whatever company you like I said, Apple, go through Yahoo Finance, go through like the different tabs and like get yourself acquainted to like the terms. So like you have the income statement, you have the balance sheet, things like that. Whatever term you don't know, Google it and learn it, and soon enough, like this will all come so natural to you. Like you will just know everything. Like you'll know how to, not everything, but you'll know how to assess it. You'll know how to look at it without even thinking, you know, what does this mean, or like how do I do this? All right, so you'll be able to recognize and actually read those things with quickness. And so the first thing though that I want to go through is like the value metrics of assessing companies. And so, you know, you can tell that a company is like overvalued or undervalued or rightly so valued. And so there's a lot of different like value metrics that investors use to assess different companies, but there's one in particular that everybody uses for every company. And this is one of the first things that I learned. It's called the PE ratio. PE ratio. And basically what this means is what you pay like for the stock price, the share price, for what you get back in earnings from the company. And so, you know, a company has revenue, right? And after they get all the money from their sales and they pay, you know, things like research and design, after they pay their workers, after they pay for the cost of goods that they had to sell, they have this thing called, you know, profit, the net income. And so that at the end of the day is called earnings. And so that's the company's earnings at the end of the day. After they paid everything down, the company can do whatever it wants with these earnings. And so when a company reports their financial metrics at the end of the quarter and at the end of the full year, they will report this important thing called earnings. And the earnings of a company, they're split up between every single share of the company. So every share gets a little slice of the company's earnings. And that's the E portion of the price to earnings ratio, and the P portion is what you pay for the share price. But one thing to note is that a company does not give back 100% of its earnings. And so this is just, you know, this is just a valuation metric. We're not saying that you're going to get these earnings. It's just that if the company were to give back 100% of its earnings, this is how long it would take to make back your original investment in the stock price in the form of the company's earnings. And so that's a quick way to go through like the PE ratio. If you have any more questions, I can make a whole video on the PE ratio. just leave a comment down below, or if not, just Google it, and Investopedia is a great source, so investopedia.com. So the PE ratio, that's one value metric that you're going to want to know. The second thing is how to read a company's financial statements. And so a company has this thing, let me write it down, called a 10K and a 10Q. And so basically what a 10Q is every quarter, okay, business operates, the full year. And the fiscal year is split into 4 quarters. And so at the end of every quarter, every public company reports to its investors and shareholders and anybody that wants to know its financial metrics for the quarter. And so it will report how much money it made, how much money it spent, how many of its products were sold during the quarter. Just different their financial metrics during the quarter. So investors can assess this business and continue to assess this business and be like, this is the company I want to invest in. This is a company I don't want to invest in. And so every quarter they report their financial metrics, and then at the end of the year they report a whole report that's pages and pages and pages and pages and pages long of their financial metrics for the whole year. And so that is these 2 documents right here. And so the 10Q, that's their quarterly. You can remember it because of the Q, quarterly. And so their 10Q, that's what they were filed with the SEC for quarterly. Their quarterly reports, their quarterly financial earnings. And then the 10K is their yearly, what they report at the end of the year for their full fiscal year of how much money they made and how they did that year financially. And so any company that you like, either I think it might be on Yahoo Finance, but if not, you can also type in any company that you like let's say Apple. I'm going to use Apple again. Type in Apple, type in investor relations, go to their investor relations page, and that company will have their 10Q, their 10K, and any SEC filings listed on that page. So I would go into these documents, and it's a very detailed document, and you're probably not going to know everything that's in it, but anything that you don't know, as far as, I would look at these 3 things: the income statement. So I'll write that down. Income statement, balance sheet. Okay, so you're going to want to look at their income statement, which basically says oh, this is how much sales we did, so their revenue. This is how much the goods cost to actually make, that we had to sell, how much we had to pay people, how much we spent in research and design, and then at the end of the day, what is our income, what is our earnings. So that's basically what the income statement says. And then the next thing is the balance sheet, which that's a very, very, very important document that you're going to want to know how to assess. And so the balance sheet gives the company's assets, says the company's liabilities, and that's very important for business. And so I will look through those documents, and anything that you don't know, to Google, and that's going to be your best friend. Google Investopedia to learn anything you want to know about these companies. And then at the end of the day, you might say Apple, they're doing $85 billion in revenue, and they're doing this much in profit. Oh my God, this is such a great company. I want to invest in this company. They don't have very many liabilities. They have a lot of cash on hand. Things like that. So you'll be able to say things like that and be like, I want to put my money into this company. And so that's very important. So just get a feel for that. The next thing, I want to make sure you can see this on camera. The next thing, I'm going to go through this really quickly so this video is not too long. Is risk tolerance, all right? And there's different approaches. So you can be more aggressive, which what that means is there's more risk in your investment, but there's probably higher returns. And so those things have to coincide. There's nothing in the stock market that's low risk and high returns. If you want high returns, you're going to have to be a little bit more aggressive. And so for me personally, my account, I'm a little bit more aggressive as far as picking stocks. if you want to be like risk aversive and like not aggressive at all, and you want to like just put your money in a low risk, it's going to appreciate. It's going to show you appreciation. Like, it's not going to stay flat, but it's not going to have high returns like something else. And so the ETF, like the S&P 500, it's an index fund of like the top 500 stocks. And so in essence, this index fund, if you put your money into it, would it be the average of like the appreciation of these 500 top performing stocks? And so in essence, if you put your money into this over a long time period, it will appreciate at a considerable rate. I think the average is about 6% per year. I think that's the average for the S&P 500, but that's very low risk, because if you're averaging it out like between 500 companies, you're well diversified. Like, you don't have to worry about anything. It's low risk. It's low risk and probably not the highest returns, but a moderate and fairly good return. But for me, I like to be a little bit more aggressive, and so I put my stocks, half into the S&P 500 index fund, and then half into individual stock pickings. And so I pick different stocks, I look at different companies, and I assess them, and I say, like, I want to invest in this company. And then I go ahead and I invest in those companies, and the companies that I invest in are more like growth companies. And so they're growing at a fast pace, and so their stock price is a little bit more volatile. Their stock price probably appreciates more, so it goes up more. And these are just like growing companies in today's day and age. It all depends on what you want to do. If you want to be more aggressive or you don't want to be aggressive, if you want to stick to index funds, if you want to pick individual stocks. If you pick individual stocks, do you want to invest in like growth stocks where like companies are like growing, or you would invest in like value stocks that are like maybe like beaten down companies that are like undervalued, and you want to come in and scoop them up, and hopefully they'll be rightly valued or can become more valued in the future. So it depends on what you want to do. The fourth thing is find a broker. Alright, so this is one of the easiest things I would recommend to people. There's different like brokers that you can use. I will name some. There's like TD Ameritrade, there's Fidelity, there's M1 Finance, there's Stash, Acorn. For Robinhood, like, you don't have to pay any commission, and so when you buy and sell a stock, you don't have to pay anything to the broker. Because if you use TD Ameritrade or any other broker, then what you do is, like, if you buy a stock or you sell a stock, then you have to pay some sort of commission to the broker for that trade. For Robinhood, there is no commissions. There is free trading. They make their money in another way. And so I would suggest to people, I would recommend to people, Robinhood. So look it up in like your app store. You can make an account. So just make an account. Once you know the basics of like investing, you might want to put your money into an index fund, or you might want to put your money into a company. So you can make an account and just get started that way. Like, it's really easy. It's very, very simple, very straightforward. So find a broker, and then you can link your bank account and like deposit money into your account and then start investing that way. So it's really easy now. Like, back in the day, people had to go to like in-person brokers and like do all of that, but you can do it sitting in your kitchen or sitting in your bed, just buying and selling companies, stocks, buying and selling different stocks. So it's very simple now. I would look up Robinhood in the App Store, iOS, Android. They have it for both. Keep learning, because even now I've been investing for quite some time, but no matter what you do, you will not know everything. Warren Buffett, one of the greatest investors, he's made billions and billions. I don't even know what his net worth is now, but he's a freaking like billionaire. Like, I'll probably never see that money in my life, but he made so much in the stock market. He probably doesn't know everything. He's still learning every day. And so whatever you do, don't stop like learning. Like it's a lot to know, and I'm still learning things right now. I'm still learning a lot right now. Like whatever I don't know, if I read something and I don't understand it, I Google it and I read about it. Cause investing in the stock market, you're gonna have to do like a lot of research and a lot of like self study, just to understand and be proficient, um, in understanding the market, understanding what's going on, and maybe even like economics and the macroeconomics. Like you know, right now I'm invested in like a Chinese company, Alibaba, if you weren't sure. And this company, you know, they operate mainly in China, very little in the United States. So it only kind of they only drive traffic from one particular country. And so whenever you know Donald Trump or President Xi of China said tariff, basically the stock kept dropping and kept dropping. Like the trade tensions, it kind of like brought the stock down to slump levels. Like the stock price was just appreciating, keep on going down. Like it was crazy. And you have to be aware of these macroeconomic factors that are happening, like this trade war. Like what's going on? Is it going to get resolved? And so you kind of, if you're invested in these different companies, kind of understand what you have to know for these companies. Like you may be invested in a company and know that like they don't operate in China. It's an American company. They don't operate in China, and so these trade wars would have no effect on it. Or like Apple, they do some business in China, and they actually just released a statement that like that in greater mainland China, their sales are going down. And so it's just like these macroeconomic factors you have to think of and you have to know. Like maybe China's economy is slowing down. People are saying that. And so it's always, this is just an example of like, you're always learning. You're always learning. Because I've never once looked at China in my life, like the GDP of like, how's China's economy going, you know? But now it's like, oh wow, like China's economy is slowing down, is decelerating growth. That may have an effect on like the companies I'm invested in. And so it's always a learning process. Even like looking at the company statements, it's always, 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 always a learning process. And so keep learning. If you have any questions on what you learned in this video, leave a comment. If you want me to go into anything that I said, like PE ratio or like how to read any of these, the income statement, the balance sheet, 10K, 10Q, I can do that for you. I can make a video on it. Just leave a comment. And I will see you guys in the next video. Thank you.